Johnson & Johnson, ticker symbol JNJ, is currently trading $146.99 a share. It's down 8% over the last year and at pretty much its 52-week low. Is this the right time to buy? That's the question I'm going to be answering today. We're going to be looking through the company's latest financials, seeing what's happening with Johnson & Johnson, and then looking at my automated stock valuation spreadsheet, seeing if there's a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and Ben Graham formula for intrinsic value. This stock is a massive dividend payer that interests some income-based investors. 3.38%. Is that a safe dividend as well? We're going to be answering that question right now. So just touching upon the earnings. Fourth quarter sales up about 5.3% to $22.5 billion. Operational growth of 7.6% and 5.7% adjusted operational growth. Earnings per share is up as well. Full year reported sales up 88.8 billion. A lot of this is due to the COVID vaccine, which was about 7%. Earnings per share $5.79. Adjusted EPS $9.98. If we go to the overall financial results, here's the full year 23. Full year 24, and then the fourth quarter. As I said, 88 billion in the full year, up from 85.3. Net earnings up as well, 5.6%, 13.2 to 14 billion. Down actually in the quarter, 4.1 to 3.4. And also, sorry, I didn't mention, reported sales for the quarter up 21.3 to 22.5. We also have, if we scroll down the segments here, US is up about 10%. 12 billion to 13.2. International down ever so slightly, and worldwide 21, well obviously these are the two added together, but 21 to 22.5. So US, the biggest segment, is up. Full year up again, 46 to 50, and as we said, 85 to 88. We have the segments here. Innovative medicine, easy for me to say, innovative medicine and med tech, both up 4.4% and 6.7. Where is the percentage? You've got it everywhere else, but you can see here that it is up as well, 21.3 to 22.5, and once again full year up 4%. So revenue is increasing. That is what we like to see. Let's have a look at my sheet. If we put in the ticker JNJ, this will load up all the latest company financials for JNJ. We can have a deeper look. If you're interested, check out my Patreon, but we'll talk about that more later. So $146.82, market cap of 353 billion, P ratio of 25.36, which is lower than the market average, currently around about 30. Earnings per share $5.79, a beta of 0.51, meaning is less volatile than the market, and analysts say it's to buy $168 a share. Dividend yield, this is the thing that people like, 3.35%. Massive dividend payer, meaning you'll get paid $4.92 a share. They pay around about $12 billion in the total dividend, which is about an 80% on the net income and 60% on the free cash flow payout ratio. Ex-dividend date 18th of February, so buy before they're going to get paid. So we have the latest earnings here. As we saw, revenue is up to all-time, well, almost shy of all-time highs. 2021, that was after the COVID year, around about 88 billion. Net income, are they able to generate more profit? Interestingly, margins are down 14.68%, down from the prior years. Free cash flow is growing. They're very consistent with growing their free cash flow, and it's at all-time highs, 20.57 billion. If we look at the operating cash flow is up. CapEx is pretty flat, but you can see the operating cash flow is up, which then in turn means the free cash flow is higher. Shares outstanding, are they buying back their shares? Yes, they are. They're rewarding shareholders. They've aggressively bought back shares from about 2013 and have continued to do so. Let's have a look at the discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows, and that'll give us a value of today. And currently, this is giving us a price of $207 a share. So let's have a deeper look and see if we agree with the numbers. Initially, we're looking at the revenue growth rates. We're expecting, oh, well, that number is exactly what it is, 88 billion, about 1%. This is because of the down year in 2023. Let's see what analysts are saying. I think we can probably be a bit more bullish with these numbers. 90 and 93 billion. Oh, actually, sorry, just before I do that, I want to look at what the growth rate is down here. 5-6%. I think that's probably about fair. So let's see if we get that. If we do 5%, it puts it up to $242 a share. Net income margins all over the place. I'm going to take out an average. I'm going to get rid of the 41%. That is a lot higher. Let's bring this down to about 19%. 189, so this brings a bit more down to reality. This number was really throwing them off. Net income to free cash flow, you can see that probably around 100. 2024 is lower, but I like that price of $190 a share for the discount free cash flow model, so it is a buy. If you're interested in checking out the sheet, this is the Patreon. Links are in the description. It's the $4 a month here. This gives you full access to the sheet and all of its data. I have a lot of happy customers at the minute. I'm pretty happy. We'll look at the Ben Graham model. Ben Graham hates stocks at the minute because of the high bond yields, which is currently at around about, still 5.2%. Expected growth rate we saw was 5%. $66 a share. We'll skip this. Dividend discount model. They consistently grow their dividend at about 5. We'll do 5.8%. Discount rate is, even if we put it about 8.5%, which is much higher than the weighted average cost of capital for JNJ, which is at 6.2, it's $186 a share. So dividend discount model really likes the stock. Finally, we will look at the comparable company model. This is a way of valuing companies looking at their competitors of similar industries and sizes. And what the sheet will do is if you put in the tickers of other companies, for example, Pfizer, ticker symbol PFE, it will load all the latest company financial data for these companies as well. We'll be looking at revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, PEG, EV to revenue, EV to EBITDA, PE, and forward P. So Pfizer, I think, are a pretty direct competitor. We'll do Merck, MRK, MRK, not MRL. And finally, we will do AbbVie. So just on these stocks, obviously Pfizer is pharmaceutical vaccines. Merck is pharmaceutical with cancer therapies and vaccines. And AbbVie is drugs like Humira and other immunology and oncology drugs. So enterprise value, J&J is the second highest, interestingly. AbbVie has a slightly higher market cap, 365. Revenue, J&J is the highest. Smallest growth rate though. Highest EBITDA. Highest net income. Second largest profit margins. Price to sales, market average is around about 3.13. J&J is the highest with 4. They're all pretty close here. Price to book, market average is about 5.24. They're actually all lower than the average apart from AbbVie. And PEG, Peter Lynch's price to earnings growth, all under 1. Ideally you want them to be under 1. And interesting to hear. I think there's probably a problem with Merck because that's very under 1, but this is why we looked at all undervalued according to this metric. So the values we're looking at here is EV to revenue, EV to EBITDA, PE, and forward P. EV to revenue towards it is lower than the average. EV to EBITDA slightly above. PE definitely lower than the average, and forward PE as well, actually towards the higher side. So this gives us an average of $187 a share. Which is pretty close to the intrinsic value of the dividend discount model. Ben Graham hates it, so we'll quickly skip that. And then the discounted free cash flow model puts us about 180. So all the models apart from Ben Graham put it around about 180. If we look at the 5-year chart, the stock has not been 180 since the mid of 2022. But it is interesting. It does look slightly undervalued at the minute. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon. There it is, and I'll catch you guys next time.